In this video, we're going to look at Vaxart. Vaxart is a biotechnology company focused on the discovery, development, and marketing of oral vaccines. Oral vaccines can be stored and shipped without refrigeration, so eliminates the need for needle injection. And it recently began a program to develop an oral tablet vaccine for COVID-19. It currently has an oral vaccine to fight against the flu. And what I do in my videos is I run my discounted cash flow model to try to figure out the true value of a company. And then I look at the financial ratios of the company and compare it with their competitors. And I do this with you throughout the whole video, so it's like we're doing it together. Let's get started with the model. This company has a market cap of $1.72 billion. So it's on the smaller side. And let's get their stock price. It's $15.75. So that's one share of stock. And now we're going to pull the free cash flows. And the free cash flows are the cash that's remaining after operating a business minus capital expenditures. And the way you value a company or an asset is you estimate the future free cash flows. And then you discount that number back to today's value. And that's exactly what I'm doing in the video here. Now I'm pulling the net income, which is a profit and loss according to the income statement. And then I'm going to pull the revenue, which are just the sales. That's also on the income statement. And you can see there's a lot of negatives here. Negative free cash flow every year, negative net income every year. So I do have a model that I developed just to look at Tesla, to figure out the intrinsic value of Tesla, because most models won't give you a value. The result will be negative. But I'll show you later how the model works. But let's move on with the analysis. So they don't have any debt on their balance sheet. Let's get the beta so we can figure out the cost of equity. And they have a low beta, 0.41, so the stock moves less than half the market. So it's not too volatile, which means the discount rate will be low. Let's get their current assets. We'll go back to the balance sheet. We need current assets for the current ratio calculation. And these are assets that can be liquidated into cash within 12 months. And it mainly includes cash, accounts receivables, and inventory. We also need current liabilities, and this is what the company owes within the next 12 months. That's also part of the current ratio formula. Let's get the equity. That's the value of the company according to the balance sheet, and that's $13 million. That's total assets minus total liabilities. And we'll get the EBIT, earnings before interest and taxes. That's operating income on the income statement. That's negative $10.9 million. So their weighted average cost of capital, which is their discount rate, is 5.5%. And that's just using the capital asset pricing model to figure that out. And let's use that percent to discount the future cash flows. So we estimated 4 years of future free cash flows. We also did a terminal value, which is all years past year 4. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $1.2 billion. We divide it by 109 million shares, and we get intrinsic stock price of $11.37. It's trading at $15.75, so it's trading at a 39% premium. So it's a sell according to the model. Simply Wall Street doesn't have a value for the company. There's just not enough data for them to look at. Plus they use analyst data to figure out the value of the company, and most analysts aren't covering this stock. Let's look at the historical stock price. You can see it really jumped up the past week or so. I really wish I looked at this stock a month ago. I might have been a millionaire today. Look at it, back in late January it was under $3. And I valued it at $11, so I might have bought the stock because it was so undervalued. But now it jumped up so much. And it might keep going up, so it's hard to predict. But I'm not sure if I'd buy it now. A traditional discounted cash flow model uses revenue, net income, and free cash flow, and it extrapolates future free cash flow based off of those numbers. So in this case, it's all negative. Negative free cash flow, negative net income. You can't have negative revenue. So it had to come up with a negative value. Any discounted cash flow model would have, because there's only negative. The way I built this most recent discounted cash flow model, the way I would calculate the next 4 years of future free cash flow is I would look at the 2019 actual free cash flow and apply a growth factor. So in this case, it was negative 12 million. So it just increases more negatively. The real change in my model was how I projected the future free cash flow after 2023. What I did was I would take the difference between the 2016 and 2019 free cash flow. In this case, it was about 18 million. And I would divide it by 4. So that means I had about a $4.5 million growth on average for 4 years. And I would assume they were at break even after 2023, and I would apply that growth. You can see this is $4.5 million of free cash flow in 2024. I would assume the same growth over the next 29 years and then do a terminal value after year 29. And then of course I have to discount those numbers back to today using the weighted average cost of capital. But the assumptions I did use all came from their actual numbers. I didn't assume something like they were going to come up with a COVID vaccine and their future free cash flow will be massive and explosive. That's what some analysts do. They make these crazy assumptions on how the business will grow. In all 5 of my discounted cash flow models, my assumptions are just based off of their actual financials. Some of my models use a more aggressive approach on the previous financials. Others use a more conservative approach. The only way I could get a positive value is if there's some growth. In this case, they grew from 2016 to 2019. They went from negative 30 million to negative 12 million, which is an $18 million growth. If it was the opposite, if they were negative 12 million in 2016 and negative 30 million in 2019, there's nothing I can do. I can't assume they're just going to start making money. They have to prove it in some way, and they did. And that's what I used for this model. Let's look at their financial ratios to get more information. So they have a negative PE because they have negative earnings. And PE is price of stock, which is $15.75, over earnings per share. And earnings per share is net income, which was negative 19 million, over shares outstanding. So the result has to be negative since they have negative net income. Some people say look at price to sales ratio if a company is reporting negative net income, because you can't have a negative price to sales ratio. But it's really bad at price to sales ratio, 233. Let's look at that in more detail. That's price of stock, which is $15.75, over sales per share. And sales per share is revenue, which was $7 million, over the 109 million shares outstanding. So investors are willing to pay $233 for $1 of sales. I like to see below 15 on this ratio. So Tesla is a perfect example of how you would use this price to sales ratio. You can see their PE is negative because they have negative net income. But their price to sales ratio is really good because they're generating lots of sales. They're just using all their revenue to grow their business. They're in such a hyper growth stage. This is an instance where you would look at the price sales ratio as an indicator of the company's future potential, not so much the PE. They have a bad price to book ratio of 132. That's price of stock, which is $15.75, over book value per share, which is 12 cents. Book value per share is equity, which is assets minus liabilities, over shares outstanding. That comes out to 12 cents. So that means if the company went bankrupt, each shareholder would receive 12 cents, which is not a good return on your investment since it's currently worth $16. Current ratio 1.9, so they can cover their current liabilities. That's current assets, 18 million, over current liabilities. That's good. Negative ROE, because as you probably guessed it, they have negative net income, and ROE is net income over equity. The best way to look at ratios is to compare them to similar companies. I've done videos on Exelixis and Royalty Pharma, and this is Vaxart right here. And if numbers in red, that means they're worse than the average. If it's in green, it's better than the average. So they're worse than the average in just about everything, except debt. They have no debt. Too bad I didn't do this stock earlier, but I just saw someone post about this on one of the Facebook groups, this stock. So thanks for watching. Leave a comment.